I'm now delighted to welcome to the stage Mr. Pablo Hernández de Cos, former Governor of the Banco de España, to deliver his keynote address. Mr. Hernández de Cos was Governor of the Banco de España and member of the Governing and General Council of the European Central Bank from June 2018 to June 24. He was also Chair of the BAL Committee on Banking Supervision between 2019 and 2024, and a member of the General Board and the Steering Committee of the European Systemic Risk Board and the Financial Stability Committee. Last week, he was announced as the next General Manager of the Bank for International Settlements. Welcome, Mr. Hernández de Cos.
Well, thank you. Thank you very much, and good morning. Thank you, Governor. Very happy to be here in Dublin again, and also thank you very much to the Minister for very nice words. My starting point today will be a statement made by a historian back in 1986, Melvin Kranzberg, who published back then his 6 laws of technology. And at the top of his list was his view that technology is neither good nor bad, nor is it neutral. Fast forward to today, and this edict could seamlessly apply to the debate about the use of artificial intelligence, something that was mentioned by the Governor in his introduction remarks, and in particular, the use of artificial intelligence in banking, and surely on the implications of the development of big techs for the banking sector. And my intention in today's talk is precisely trying to bring together both the micro but also the macro-prudential and financial stability considerations related to these topics, AI and big techs, in connection with the banking sector. As you will see during my talk, I have more questions than answers at this stage, but maybe there is a strong and safe conclusion that I can already anticipate, which is that the need for global cooperation is stronger than ever. And by the way, this is not only in the field of financial or banking regulation and supervision, but I think this need also applies on other domains. And by the way, these other domains, and this is probably one of the key conclusions I will be drawing today, that we need to incorporate them also into the banking and financial field. So let me start with AI. At present, banks are using AI in various use cases and small scale projects. And this use is, of course, driven by an expectation or hope that AI will increase banks' operational efficiency, risk management capabilities, and product offering. More specifically, the potential benefits could include, first, improving the client experience, as the technology can help streamline customer interactions, such as applying for a loan, by removing manual steps. Second, superior pattern recognition ability and predictive power compared with more traditional approaches, for example, in improving investment performance, detecting fraud, or expanding credit access. Third, cost efficiencies. AI may be able to arrive at outcomes more cheaply with no reduction in performance, such as increasing self-service by customers. Fourth, greater accuracy and consistency in processing compared with processes that have more human input and higher operator error, such as detection of anomalies, for example, in AI, AML recognition. Better capability to accommodate very large and less structured data sets and to process those data more efficiently and efficiently. For example, the ability to gain greater insight into customer needs and the provision of more tailored or customized services. In practice, the focus is, at least till today, centered around generative AI, with specific use cases around robo-advisors, document summarization and translation, fraud detection, and code generation and testing. And overall, we can say that banks appear to be using AI cautiously for higher risk use cases, with few processes fully automated and most retaining human judgment in any decision making. And at this stage, it is mostly focused around cost savings or operational efficiencies and less on revenue generation or broader societal benefits. This is about the benefits. With regard to the future implications for bank safety and soundness, and more in general for financial stability, AI exhibits many of the same risks as other complex models. But they may also amplify or even introduce novel risks depending on their specific use. Let me mention at least 4 risks in particular. The first one is an obvious one, is model risk. AI models are complex, and we don't really understand how they work. In some instances, relying on hundreds of billions of parameters. The issue of model explainability is indeed an important one, but we need to think more about what we mean by explainability. In my view, it's more how and under what conditions and what constraints are we going to use AI models. Given what we know and what we don't know, when and how are we going to deploy AI? As with all models, the output is just an estimate. It doesn't guarantee you will always get the right answer. In the case of generative AI, the so-called hallucinations or the generation of responses that are factually inaccurate. And we are comfortable dealing with model error for traditional models. So the question is how we get same level of comfort with AI model error, and maybe just needs time and experience. The second issue is around data governance. The use of AI can increase the challenges of sound data governance given the very large data sets, which in some cases the banks do not control or cannot fully evaluate. AI may also rely on data that have shortcomings in terms of quality, suitability, or reliability, and may also reflect and even augment human biases. For generative AI, given the large volume and variety of training data, issues around privacy and copyright are more pronounced. Third, governance and accountability. Banks' governance frameworks and processes may not be adequate for AI usage. Banks may lack the appropriate skills and knowledge to build, scale, and integrate foundation AI models or to provide effective oversight. And fourth, third-party risks. Banks may increasingly rely on third-party model providers because they lack the skills and resources to develop AI models in-house. When banks use vendors or open-source models, this can amplify risks related to transparency, to privacy, to cybersecurity, and to operational resilience, among others. If we move to the micro to the macro perspective, from a financial stability perspective, the broad adoption of AI may also lead to increased interconnectivity and interdependencies across the financial system, the amplification of traditional financial risk, including procyclical behaviors, and greater third-party concentration risks, particularly where the model vendors are also providing cloud service to banks. And very importantly, we have also yet to see how AI performs across a full financial cycle, and this could be some time off. Left unchecked, such models could potentially amplify future banking crises. But on the flip side, the models, you know, are probabilistic, so that works to mitigate somewhat the potential herding effect associated with relying on a few models. All in all, in my view, we are facing a combination of big change, big impact, and a high level of uncertainty. The good news is that these underlying issues, or at least most of them, are already covered to some extent by existing, for example, Basel Committee, Basel standards, and guidance. This includes guidance on governance, on risk management, on risk data aggregation and risk reporting, on operational risk and operational resilience. In addition to the general risk management requirements, the Basel framework also includes specific requirements for risk modeling, and in particular for the calibration and validation of internal models. However, there may be elements that need to be adopted and expanded to reflect developments in AI, and in particular, I would say that an increased reliance on different types of data raises broader public policy questions related to data collection and consent, privacy, bias, and security and storage, things that were also mentioned by Governor McLean at the introductory remarks. Many of these challenges cannot be solved by banks or supervisors alone and are likely to require cooperation and coordination with a range of public sector authorities. Let me now move to big tech and the implications of big tech, the connections between banks and big techs. Here, let me distinguish between three broad types of interconnections. The first one is big techs as service providers to banks. The second one is big techs as direct competitors to banks. And then finally, big techs as partners with banks. Each of these interconnections pose slightly different challenges for regulation of the financial system, but of course, taken together, they point to the increasingly important role of big techs in the financial system. So let me start with big techs as service providers. It is clear that banks are becoming increasingly reliant on big tech as critical third-party service providers, and in particular providers of cloud computing services. Banks and jurisdictions are moving at different speeds in terms of how strong these connections are, but the trend is pretty clear. And by the way, these interconnections are likely to increase over time. The migration to cloud computing is not a banking or financial system specific trend, but rather something that it is happening across many sectors, many industries. It is worth recalling, by the way, that the provision of such service by big techs was not their main business model at inception. Google was a search engine, Amazon was an online bookstore, Microsoft was primarily known for its Windows operating system. Yet, these services now form a significant portion of the revenues. The Economist reported a number of around $500 billion in revenue for big techs providing these services in 2022. This evolution of big tech highlights the versatility of these companies to adapt to evolving trends, and I think it's also a good reason to ask ourselves whether a similar trend could happen with regards to banking services. On the specific case of cloud computing, I think the cost and benefits of these increasing interconnections at the micro level are generally well recognized. On the benefit side, there are opportunities to increase overall efficiency, to lower cost, to increase flexibility in deploying and scaling back services, better security, and generally access to best-in-class services that many individual firms will not be able to match. And in certain areas, the big techs have a scale and expertise that simply cannot be replicated by many other firms. On the cost side are, of course, concerns around data safety, security, banks being locked in, access rights, and being able to manage a new set of risks. Maybe to put it in another way, at the individual firm level, there are risks in moving to the cloud, for sure, but also significant risk in not doing so. Again, I would say that these are the kind of things that are within the scope of bank risk management and supervision oversight included already in national legislation. Managing critical third-party services is nothing new, and banks and supervisors have extensive experience in managing this risk. None of these issues are easy to get right, but they do feel manageable, and good risk management can get you a long way. The question that then arises is it enough to regulate, supervise this from within the banking system, just focus on user demand side of these services, or do we also need to oversee from the big tech side as suppliers? That's, for me, the big question. The main reason for thinking further about the supply side is the industry-wide concentration risk. A handful of big tech firms control a very large percentage of the cloud computing market. Even after all the best risk management practices are put in place at the individual firm level, there is still going to be the large system-wide concentration risk. And this is not an issue that is unique, by the way, to the financial service. The concentration risk can't be addressed by bank supervisors alone. The issue is much bigger than that, is therefore likely to need a higher level of government action level coordination. The second type of interconnections is big techs as direct competitors with traditional banks, either inside or outside the regulatory perimeter. And when I talk about the regulatory perimeter here, I have in mind prudential regulation as in entity, level capital, and liquidity requirements. I'm not talking about product-level regulation, such as consumer protection. In terms of activity within the regulatory perimeter, perhaps unsurprisingly, there hasn't been much activity. So far, big techs have focused on their main expertise, providing technology rather than banking services. If big techs end up buying banks or starting new banks, then they will be licensed and in the regulatory perimeter and subject to the same regulation as any other bank. The main regulatory issue that we will have to address here is whether you think there should be a separation of banking and commerce. That is a substantial issue on its own, though not a new issue. Here, practices vary across jurisdictions. In many jurisdictions, there is no explicit separation requirement, even though in practice the activities tend to be separated. The other potential case to deal with is big techs that start providing banking-like services and do so initially outside the prudential regulatory perimeter. I'm not aware of any live examples of this, though we are also familiar with the Libra DM example. We can rule out something like that again in the future, and I suspect similar new proposals would receive also similar responses from the public sector. The third type of interconnections between banks and big techs is in the form of partnerships. As someone put it, collaboration is the new competition. Most of these partnerships have been between banks and fintechs, but we also have examples with big tech players. In terms of the services that have been provided, it has been predominantly in the areas of payments, but it's also expanding into lending, mainly on credit cards, but less so into deposit-like products. Again, it's worth noting the divergence across jurisdictions, with many emerging countries being at the forefront of such partnerships, China being at a much more advanced stage with Ant, but Mercado Libre also in Latin America is a very good example. So what does this mean for the path ahead? Just a few thoughts here. We may very well find ourselves in a tight situation with a patchwork of banks, fintechs, and big techs. And what would happen in the case of a failure of a major player, bank or non-bank? It is not always clear as to who owns the risks. If the delivery of financial services becomes even more complex in good time, will that make resolution also more complex and costly? Central banks and supervisory authorities can actively shape the steady state. The transition is somewhat depending on the shape of regulation. So we may want to start thinking of big tech, fintechs alongside the broader MBFI spectrum. In many ways, they are part of the same set of entities and raise the same financial stability questions. Are there instances of leverage and maturity transformation that are not subject to commensurate regulation? It's also clear that there are certain issues that extend beyond the financial system and would benefit for much more closer collaboration across different authorities and sectors. And the example of concentration of cloud services, cloud computing, is an obvious one. There is also a range of work more broadly going on related to digitalization, how that is affecting both banks and regulatory and supervisory approaches. And one aspect of this broader range of work which I would highlight is on better understanding the development of banking as a service. Everything is as a service these days. So let me tell you what I think it means and why it could raise a number of issues to regulators. Imagine a firm sets up a bank that purely acts as a service provider to other firms that want to offer banking products, be that payments, deposit, or lending type products. The firm can rent out its banking license to non-banks that want to offer banking products. How should we think about regulating such a bank? Is it any difference to how we would regulate a bank that relied almost exclusively on broker deposits for its funding and mortgage originators for this loan portfolio? Would being technology neutral dictate that this type of bank could be regulated just like a traditional bank that similarly relied on third parties for its funding and asset origination? If such a bank was created by a big tech, would that change how we view it? Well, sorry, more questions than answers, but the point here is that it's clear that digital innovation will further fuel cross-border and cross-sectoral financial interconnections. So let me conclude with a few final remarks. Safeguarding global financial stability will require ongoing international collaboration to ensure that we achieve an appropriate baseline regulatory and supervisory approach to overseeing the use of AI in banking, but also the impact of big tech on banking. This collaboration is likely to extend across a wide range of authorities, going beyond just central banks and bank supervisors, given the ongoing growth of non-bank players and the blurring of regulatory boundaries. Some have even called for a techno-prudential approach to governance, building on the macroprudential framework to oversee system-wide financial risks. And when it comes to a specific of banking, it is critical that banks anticipate and oversee the risks and challenges posed by this risk, both at the micro but also at the macro level, and incorporate them in their day-to-day risk management and governance arrangements. But it's also crucial that central banks and supervisory authorities anticipate and mitigate the potential risks and vulnerabilities to the banking system. Thank you.
Thank you, Mr. Hernández de Cos, for what I think we'll all agree were you raised many interesting points and questions for us to consider in the context of our conference theme today, delivering a well-functioning financial system to support a changing economy.